over here, and you can see we did get a negative divergence there. Prices broke down very sharply, and we got confirmation of this downtrend throughout that entire period. Let's roll forward to another event. And what I want to show you here is the collapse of the tech bubble. Again, over here we see confirmation, and we start to see distribution. This is when money was getting really wacky, and we were seeing, companies just pop up everywhere, trading $300 a share, and then they disappear. Ultimately, here's our top over here in 2000, and a lot of people probably remember this breaking down, but you can see this divergence just getting worse and worse and worse. And look at the lows it's at as we're making the very high in price. I mean, the lows correspond with a level way back down here. And there's the Qs, and the divergence there is actually very pronounced and very sharp. It happened very quickly. And we see our move down and a bit of confirmation. The next time period that we're going to roll into is the current bull market rally that basically bottomed in about 2002, started moving up in 2003, and I brought us up to the market top of 2007. As the uptrend progressed, we saw confirmation, higher highs in price, higher highs in the indicator up to this point, about mid 2007. Actually, probably earlier. Over here you can see this indicator just take a nosedive. Here we are at the highs. You can see if we draw a line across over here where price is here and the indicator is here compared to where price is way here. It's a very, very negative divergence. This is a leading divergence. It broke down over here, and we have confirmation, and it continued to move down that. So we're just going to move forward to a rally, big bear market. Here we're looking at the bottom that was put in about February, March of 2009 that led to this most recent rally. And you can see again the positive divergence over here. Price has made a much lower low, and 3C has made a higher low, and we get a big leading divergence here. So there's a lot of accumulation. Again, this appears to be a inverse head and shoulders over here, and our breakout level would be somewhere in sorry about that. Somewhere in here is our breakout level. If we roll forward, we're going to see a pretty bad negative divergence develop. And around October, we started seeing negative divergences, and here, over here is a pretty bad negative divergence, and we saw a drop there. And ultimately, we made our highs over here in April, and you can see again just a negative divergence in this whole area. We didn't make any higher highs from these 2 points, so we have a negative relative divergence there. And now we've gone into this leading negative divergence where we're seeing lows that we haven't seen on this chart, and price is still at a level over here that's fairly high compared to down here, but the indicator is much, much lower. So that's a leading negative divergence. What I want to take a look at now is really the current situation that we're in. I've gone ahead and jumped back to the spiders, and there's a couple different top options. Well, there's two different top options I see here. I'm going to draw some trend lines real quick, but the first, and I think the most likely, is a broadening top. So this is about the level in here, and broadening because it broadens out at a right angle like this. There's a couple different versions of it, but that's a right angle broadening top. Typically we see about 5 points of contact before the breakdown, so I'm not sure where exactly we'll call this as starting, but let's just say we had 1 and 2. Let's call this over here 3, 4, 5, and what happens is the next rally should make a higher high, and it fails to do so, and then it moves down. So it's moved down to that support level. It actually broke through it the other day, and this is where we went long when we caught this little bounce. because our indicator suggested that we were going to see a bounce and that this was not the ultimate break. The other option would be a head and shoulders top where we make another shoulder over here. So we'd have basically shoulder, head, and another shoulder form. So every head and shoulders top first starts as a broadening top, and I do believe that this is going to be a broadening top instead of a head and shoulders top, because events are unfolding so quickly around the world right now, and there's so much artificial support in the market, and I just don't think it can last too much longer. And that would bring us to the question of where are we going with this? So let's take a look at, here's a 5-day chart of the Dow Jones. Let's see how much time frame we can cover here. We can cover pretty good, but let's look at the S&P. I think that's probably a better index at this point to be looking at. We have something that looks a lot like a double top. It's very large for a double top, but again, it does look like it. The support level over here, again, was broken. And we got that bounce. So this bounce now, we have to look at this and say, well, you know, this is about 75, this is about 150. If this were our typical measuring implication, then we would have to deduct 75 points from the breakdown level at 75, which would put us at 0, which naturally I don't see occurring. But I do believe that we are going to enter a long-term secular bear market. And I think we're going to see a very fast fall very soon here. Probably hold up over here at 75 on the SPY. And I think ultimately we're going to see a break of that. We're going to see new lows. Again, this is the bottom where we saw the rally launched in February, March of 2009. But ultimately, I think we're headed to new lows. So if you're in the market, this is a time to be very, very careful. If we just take a real quick look at where we're really at, you know, today, we've seen some very volatile moves. We did buy this bottom and rode this little bounce up, but now we're seeing a negative divergence in this, and I'm going to show you a little bit more clearly. Over here you see the negative divergence, and this is where we got the sell-off. We did get a bump. 3C did not respond whatsoever to that. It did not move up even a little. It is in a huge leading divergence. This is the most negative of divergences that you can get. It's showing extreme distribution or short selling, and I just don't think there's very much time left. I think it's probable that in the next week or two that we are going to see a move back below the 104.50 area in here. So if you have friends in the market or family in the market, or if you're in mutual funds, I would really think hard about where you want your money right now. Anytime you put your money in the market, it's at risk. There's no safe investment. The mortgage-backed securities were supposedly safe investments, and that's pretty much what got us into the mess that started in 2007. And we see Europe collapsing now. The world is a lot different. The charts that we looked at, the Dow Jones, were pretty much American-based, you know, until we got into the 80s and the 90s, where we got more of a global economy. But now we're a very global economy. Everybody's interdependent upon each other. Europe is collapsing. The United States, I think, has just seen the beginning of what's to come. I think the second shoe's about ready to drop. So anyway, if you want to see more, stop by tradeguild.net. And if you really want to get into the specifics in tactical and strategic planning, check out our sister site, Wolf on Wall Street. There's information at tradeguild.net about Wolf on Wall Street. And if you have any questions, feel free to email me anytime. Thanks. This is Brant from tradeguild.net. Have a great Memorial Day weekend.